Welcome to this stock analysis update for Yellowcake. Yellowcake are listed on the London Stock Exchange and they give you the opportunity to invest into the spot price of uranium. This is triuranium octoxide, which is the yellow powder used to make fuel for nuclear reactors. Yellowcake are effectively a ETF, although they're structured as an equity. All they do is buy and store uranium, and they currently have over 22 million pounds, which is worth 1.4 billion. The uranium is stored very safely in a Orano site and a Cameco site in France and Canada, and they have a agreement with Kazatomprom to buy up to $100 million worth a year until 2027. Uranium has two prices, which is the term price, which you see in dark blue here, which is contracts for delivery in a time span of longer than a year, and spot price, which is all contracts for delivery within 1 year. And Yellowcake track the spot price. You can see that we had a 20-year bear market following the 2007 bubble, and Yellowcake IPO'd in July of 2018 with their initial purchase of £9 million worth of Yellowcake. Before I continue, please remember that this is for entertainment purposes only and speak to a qualified financial advisor before making any investment decision. But on that note, I myself invested in Yellowcake back in 2020. And since then, we've seen a nice bull market in the price of uranium for both the long-term and spot prices. You can get these prices off the Cameco website. The long-term price is reported monthly, and however, the spot price comes out daily. But on Cameco, you can only get these monthly numbers. But I've been using the Yellowcake website to get the daily updates. So I've been updating these, and we can see now in a closer resolution how following a massive bubble really in the spot price, culminating in January of last year, it's been in a rapid decline and is now actually crashing below the long-term price. About a year ago, I released a video on Yellowcake, and at that point, I actually sold half of my stake. And really, this update's about what do I do now, particularly as the spot price is drifted below the $70 stop loss that I'd set. In terms of the equity Yellowcake, it's almost a bit nonsensical to go into their profit and loss account because all they do is buy uranium and store it. You can see that their income or expenditure is essentially how much the value of the uranium they hold has gone up or down. One thing that is worth noting is looking at them as how expensive would they be if they were a traditional ETF. And when we look at their running costs, they're currently 0.6% of their total assets. So I actually do consider them a fairly efficient way of investing into the uranium spot price. In terms of the assets, as you can see, it's just the Yellowcake that they store, and they've built that up to a impressive 1.8 billion when I last measured it, as per their 2025 half year data. And they had some cash at that time as well, and absolutely no debt. They're currently trading at a discount to NAV of about 15%, which is quite typical for them. But they do have the option, if the discount got too excessive, of selling uranium and then using it to buy back shares to help get the stock price closer to NAV. Although they are very restrained and haven't really done that much. Here I've got their assets over time, and actually one thing is that their full year is in March. So this 2024 data here, that was actually up only until March of 2024. 2025 data will run out this month. Looking at how their assets have gone up since they IPO'd, we can see that they've been very successful with sequential capital raises every year, increasing the amount of uranium they hold. And in red, you can see their cash that they've had as well. In yellow here, we see how much extra pounds of uranium that they've acquired. This is all data that I've collated myself. It is actually quite notable, though, that after sequential years of raising money every year to buy uranium, it appears that unless there's some sudden announcement in the next 24 days, it appears that this financial year, will be the first one where they haven't found the appetite to be able to do a capital raise, or are holding back on doing a capital raise for some other reason. So that's certainly something that's very notable. In terms of shareholders, they've actually got quite a diverse array of major shareholders. A lot of these previous ones are probably still shareholders, but as they've increased the numbers of share in issue, they've gone below the 3% reporting threshold, which is why we lose track of them. But it is actually notable that even in the last year, they've been acquiring new shareholders, most notably VanEck. I'm sure some of you are quite familiar with VanEck because they're fairly prominent on YouTube. So it's interesting to see them with a nice holding there. But that actually covers all there is worth going into in terms of the actual stock. And so for me, really, it all boils down to the price of uranium. Now, I've just released a 1 hour video on uranium and the supply and demand dynamics. So make sure you take a look at. You'll see a link come up for that at the end of this video. So to summarize what my findings were, the first thing is that when I initially invested back in 2020, the spot price of uranium was only about $30, which meant that actually 40% of the mines in the world couldn't operate at a profit. Whereas now, at a $65 spot price, practically all of the mines in the world can operate at a profit. So that's one very significant factor that's changed from when I first invested in them to now. Also, a lot of the data really does point to there being a match between supply and demand for around the next 4 or 5 years. And back in 2020, when the price was lower, there was definitely a shortfall in supply. But we've got to be realistic that even these basic data charts that we see going around, they're telling us that there is roughly a match up between supply and demand for from now for a number of years. And the shortfall again won't be until the mid 30s. I also went through the entire supply dynamics and found that the actual headline data is fairly wonky. And then also there's lots of undercurrent and things going on in the background you can't see. And these undercurrents, for example, government stockpiles, one example could be government stockpiles being dumped onto the spot market, or unknown mining supply being dumped onto the spot market. There are undercurrents here which can drag down the price without there being much warning of that. So when you look at the basic supply and demand data, which is wonky itself, you've got to attribute massive error bars to that and treat uranium as a high risk investment. There's a beautiful trend with the uranium price where, when in the past it's had these bear markets, the spot price drags the long-term price lower. And we can see that what happens is that the term market volume, so 2020 was the back end of that, and you can see how as the spot price was dragging the long-term price lower, what was happening is there was very low term market volume. This thick black line is term market volume plus secondary supply. So there was low term market volume, and then because miners were just buying off the spot market, and also utilities were buying off the spot market to make up for the shortfall in term market volume, because why would people be buying on the term market when they can get bargain basement prices on the spot? And you see this play out in this graphic here, because you can see how in those times there was low term market, and that was made up for with high spot market volume. But we see that as the price of uranium went up, the market looked tighter with a match between supply and demand. We can't actually see a proper breakdown of what miners are supplying in every year, but I was able to get that for Cameco and Kazatomprom, and compare that with total world production according to the official sources for that. And this gave us some interesting information in that the inventories were stable, and that's a good data point moving forward, because if you see them drop, that's obviously bullish for uranium, but if we see them increasing, that would be bearish. But the other important thing was that we see that although Cameco and Kazatomprom have been fairly constrained in terms of sales, the production has been only increasing and is now topping their sales. And we also see that despite their sales discipline, the total production in the world is definitely increasing. And I found this particular data facet to be a definite yellow flag. There's definitely something going on here, which is like a yellow flag. A lot of talk about overfeeding during uranium enrichment, but I found that actually, even when the Russian supply goes away from the US, as it has done this year, the blue team countries are fairly well covered for enrichment still. That's mostly because Europe have been and still are filling their boots with enriched uranium from Russia, coming in at a 0.1% tails assay. I did some calculations and found that, and by the way, please, I'm hoping that someone could double check this and let me know in the comments if they think I made a mistake. Go over and look at the supply and demand video where I go into the maths I did there in quite some detail. But bearing in mind that my maths could be wrong, according to my calculations, if Russia banned the export of enriched uranium to Europe, which could be a thing given what's going on at the moment, I think that the overfeeding trope could actually become a real thing in that case. And I calculated that a jump up in Europe to 0.3% tails would be an extra demand of £22 million. And if it was 0.4% tails, that would actually be a £61 million increase. So I think the 0.3 is more likely, but clearly, if Russia do ban the sale of enriched uranium to Europe, that could actually put a bit of a rocket under the uranium price. In terms of reactor demand, I found that the majority of the increased demand, we're going to have to wait until 10 years onwards. So there is going to be a big ramp up, but we've got to wait until the mid 30s for that. Here was my summary in that last video I did. And overall, and perhaps I should go into the 5-year time period here, my base case for uranium at the moment is that the long-term price should actually stay steady for quite a number of years, because there's a match between supply and demand. However, there's also a chance, talking about all these hidden undercurrents, material may be slipping into the spot market, and we could see actually a repeat of what happened last time, where we see the spot price dragging the term price down as utilities and miners pick up spot material on the cheap rather than doing it properly using the term market. So given that my stop loss has been breached and stop losses are very important to me in terms of my own personal psychology for investing. My stop loss has been breached, and so I've decided to sell the rest of my uranium. The main reason being, I think the base case is a sideways movement because supplies match demand for quite some time. And there's also a reasonable percentage probability there could be some clandestine undercurrents at play, perhaps in China or Kazakhstan, to drag the price down exactly the same way as we've seen historically. So, of course, that's my personal decision from my own personal unique set of circumstances. I did buy, remember, back in 2020. So it's a nice 2.6x for me overall. And so I'm fairly pleased with how this investment has worked out. And I will be keeping an eye on if there is any kind of Russia ban, because if that happened, I might buy back in. So I hope you found this video useful, and good luck with your own investing. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.